All right. Welcome on in, everybody. Chris Harlow here with Harlow Wealth Management, and you're tuned into another edition of Wisdom Wednesday. And I know that it's been a little bit of time has passed since we've had our last online webinar, but we got a great one today. And I'm going to be joined with Ginger Skinner. Ginger is an estate planning attorney based out of the Portland metro area. And I know some of you have had the opportunity to work a little bit with Ginger. And today, Ginger, we got a nice topic to talk about estate planning. But before we get into that, I know we have a lot of people that had signed up for this event. So we're going to give a few minutes to let everybody come on board and get registered on, and then we'll dive into the content. And also, Ginger, before we get started, I have a few housekeeping items for everybody. Number one is the chat box feature. So today is really about Q&A. You know, I have a lot of questions that I'm going to be asking Ginger and having the opportunity to interview her. But I also want everyone here to participate as well. I know some of you have had some of those lingering questions in your mind, and estate planning and just the estate laws in general can be a little confusing. It's not something that we deal with every year or very regularly. So although it's an important part of financial planning and making sure we get things right, it's not something that we come in contact with a lot. So I know that there's going to be a lot of questions, and there's no bad questions. So I'm going to ask as many questions as I've heard along in my career and just, you know, really high level stuff. We're going to keep it simple today. But if you have one that's been lingering in your mind, please feel free to put that in the chat box. And we'd love to hear from you. All right. And also make sure that you use that chat box feature to let us know where you're logging in from. Always good to know. I know we had 148 people that were registered for this event, and which is quite a lot. And I know many of you are clients, and a good number of you are also looking at the prospect of working with Harlow Wealth Management. And, you know, I always like to say that here at Harlow Wealth, we're really best suited to help those that are nearing retirement or already there and are feeling a little lost or unsure about the best approach to retirement, because there's a lot more questions that seem to come about during this time of life. And really what we do is make sure that you're feeling confident as you enter into that time, those golden years. And so you can go do the things that you always want to do, whether it's travel or hanging out with the grandkids or taking up that hobby that you've wanted to do. You know, it's just a bigger mountain to climb. And so we really want to put our best foot forward in making sure that you have a financial plan that's built on a solid foundation. And for many of you listening, you know what that foundation is. And some of you still have some questions. So if you have some questions, I want to encourage you to reach out with the advisor that you are working with. And if you're not currently a client of Harlow Wealth Management, it's really important that you take the time to take us up on that free consultation and sit down with one of our advisors here in the office so that we can pinpoint and direct you in the best direction moving forward as you build out that financial plan for yourself. And Ginger, you're a big part of that. You're a big part of the estate planning piece of the Harlow Way. So in the Harlow Way, we really, as we build out the financial plan for our clients, we have 5 key areas that we focus in on. And one of those areas is estate planning. And you, as well as anybody, know how important that is. I get to actually see your blogs from time to time as I'm scrolling through LinkedIn. I see them come up, and you know, it even poses questions to myself about, oh, actually, that's a good question. You know, I'm not quite sure about that. I need to talk to Ginger about that. So, you know, I know we got a lot of great questions that are going to come about today. So I'm really excited to take the time and have you on. So first of all, thank you for joining us today. It's been a little while since we've had you on, but it's always a pleasure. And I know a number of people here may have heard your name, but maybe don't know the full background of yourself and your firm. So why don't you take a minute to just introduce yourself and let us know your background, how you got into estate planning, and maybe why you even like it.
All right. Well, thanks for having me on, Chris. So I've been an attorney since 2005. That's when I passed the bar. After I basically took the bar and then went to Thailand for fun to wait for my results to come in. So I was lucky in the sense that I wasn't focused on, I wasn't stressing out about when my results were going to be in. And then after I got my passing results, I went to UW for a year for a master's in tax law. So I don't ever replace anybody's CPA, and I work collaboratively with a CPA. But I also speak the same language as CPAs, and these tax concepts, we tend to be on the same page for. So anyway, I have had my own practice since 2013. It's a small office. I have one other attorney that works for me, and then a paralegal. So we keep it pretty small. But we've been lucky to have really good clients. So this area of law attracts a lot of good clients. It's a little bit of a disconnect because I see a lot of the really bad things, but then for the vast majority of my clients, things go as planned, and you don't have a whole lot of weird family dynamics. So I've been fortunate enough to be sensitive to some of the issues that can come up, but I also know that most of my clients aren't going to have some of the craziness. But you have to be exposed to some of the craziness, otherwise you have no radar for the fact that it could even be a possibility. You're naive. You're naive to undue influence issues, or we try to plan around that.
Yeah, absolutely. And let's not discredit being on the smaller side as far as the firm goes. I think that allows you to take a closer look at situations and really provide maybe more leadership, because you don't have that cookie cutter approach that you can sometimes see in the bigger firms. So I think that's nice. And so we have had a nice working relationship for some years now, and you've worked with a lot of our clients, especially those that are on the Oregon side. But I also know that you can do some work on the Washington side as well. Is that correct?
Yeah, I'm licensed in Washington. I've filed some cases in Clark County. I don't do it enough at this point to want to do anything that's contentious at all in Washington. But Oregon's, pretty easy. But the short answer is yes, I'm licensed, and yes, I'm aware of the tax issues that happen for Washington State.
Yeah, great. Well, it's always good, especially for a lot of our clients that are right here on the border. Sometimes they might live in one state and also own property or have some sort of interest in the other state, or, Washington to Oregon or some others around the West Coast. And so the thing I like about our relationship is not only do you have that knowledge of just estate planning tools and laws and the necessary legal documents that are necessary, but you mentioned that you went and got your master's in tax. Now, my time at the IRS, I'm also a CPA. I worked for the IRS for nearly a decade. So I know how wide the tax code is in the United States. It's enormous. So you got income tax and all these other types of tax, but your specialty really falls on the estate tax side of things. And, I know a lot of people have heard about the estate tax, and I think they automatically think to the federal estate tax, but a lot of people aren't really subject to that federal estate tax level. Some are, but most aren't. However, they're a little bit more surprised to learn that there is an estate tax at the state level when it comes to Oregon and Washington. Tell us just a little bit about the estate tax at the state level, and how often do you see that apply?
In Oregon, it comes into play a lot, because if a person passes away with more than $1 million in assets net, that's what triggers the need to file a tax return. You get into enforcement issues, like how does the Oregon Department of Revenue know? But when I've talked to them about, compliance, basically, they say, well, the penalties are so harsh for not filing that that ought to motivate people to file when they need to. The penalty is basically, I think it's after 4 months, I think it's about 20% of the unpaid tax liability is assessed as a penalty.
Yikes.
But where it gets really, where it doesn't sit right with me at all is you can have somebody that dies in Oregon and all of his family is located in California. So they go to their California attorney and say, well, how do we administer this estate? And, they talk to their California CPA about tax returns. And by the time they talk to the fourth attorney or fourth CPA, somebody says, by the way, I think there's an Oregon estate transfer tax return. And it's already in that phase where filing it is late, and you cringe because the clients talk to multiple advisors all in California and nobody's alerted them to this. And so at that point, if you go to the Oregon Department of Revenue and ask them to waive penalties, they would say, well, why should we bear the brunt of you not working with local advisors? You should have worked with an Oregon attorney or Oregon CPA. So, the estate that I'm thinking of, I did seek a penalty waiver and they didn't waive it.
Is that right? They did not waive it. Wow. They did not
waive it. And I said, what more was my client supposed to do? They went to 4 advisors. And I think it was like the 4th advisor they went to was a friend of mine from law school. And he said, oh, there's Oregon issues here. You need to go talk to Ginger.
Huh.
So, it was like, it was a $20,000 penalty. It's $100,000. So anyway, there's things like that come up. But, back to, I can give you parades of horribles, but usually those things don't happen with my clients.
Yeah. Well, good to know. Well, I do have some other estate tax questions for you, but before we get into that, I want to start with some high level stuff, things that I hear from people that I meet with. And, I want to start with just a general will, and when is a will necessary? A lot of people that come into our office, they might have been told they need a will, and they might have got one, but typically it's pretty outdated. It was done, a number of years ago. So my question to you is twofold. When do you need a will, and how often should I keep it up to date?
Well, a lot of estate planning documents should be reviewed if they're more than, 5 years old or 7 years old. The reason why I bring that up is that the federal tax code has changed a lot in the last 10 years. For example, the older documents will do everything that they can do to try to utilize both spouses' estate tax credits. And now under new law that's been out, I don't know if it's been out 4 or 5 years, actually probably longer than that. We can take unused tax credits and move them over to the surviving spouse only at the federal level. We can't do that at the state level. So we don't need to jump through the same hoops that we did before for federal purposes, but at state purposes, we still have to weigh it out and see if it makes sense to do it.
Gotcha. So, so you said 5 years is kind of like the bright line test where we should start to update. And, should everybody have a will? Is that something you'd recommend?
So let's go a hypothetical. If you ask attorneys questions, they're always going to respond with it depends. So say you've got a 97-year-old woman whose husband's passed away. She has 4 children. She sold her house. She has everything in investment accounts and has everything as pay on death beneficiaries to her children equally. No other assets. Isn't disinheriting anybody, isn't leaving anything to charity, just wants everything to go to the 4 kids equally, and has her beneficiary designations updated to reflect that. Somebody in that position can get away without doing a will. But as soon as you get into the realm of, well, this child has already received there are plenty of gifts during lifetime, and I don't want to leave him anything at death. Sometimes it's nice, even if beneficiary designations would be controlling. Sometimes it's nice to have a will that says I'm expressly disinheriting this child because they've received substantial gifts during their lifetime. Just for clarity, my intent is to leave everything to all 4 kids equally. Wills are they can be a good reflection of your intention, and they can help control the disposition of assets if you were to pass away. We more commonly use them for adults who are, in their 30s or 40s. With a will, there's no probate avoidance. So if a person passed away having only a will, for that will to have any teeth, we have to take it through probate court, which is a 6-month process. And it's in Oregon right now, we say it's about $5,000 of legal fees and court fees and different things like that. In other states are more expensive, like California is more expensive than that because they will base their fees on the total value of the estate. Oregon, we usually bill a lot of our time out hourly instead of just looking at total value.
How about Washington? You know how they work?
Washington, I believe, is still along the lines of Oregon, but that's what my expectation would be.
Right.
Yeah, for a will to have any teeth means you got to go through probate court. So that's kind of opens the door for why people do revocable trusts. With a revocable trust, if all your assets are retitled in the name of the trust and you pass away, your successor trustee can step in and make decisions without a judge needing to oversee everything. Gotcha. So that if you trust your family, that's a good route to go. If you want court oversight, then you're going to want to, a will is going to be more attractive. There's still ways of getting court oversight with trust. You just ask for it. But the default is that people are going to handle it on their own without a judge looking over their shoulder. Washington and Oregon also have, even in their court systems, there's some variety. Washington, they issue non-intervention powers, which means the judge basically says, you as a family figure this out. Once you've got it all done, provide some paperwork to me saying you've taken care of everything, and they sign off on it. Oregon is much more paternalistic. They want to make sure that everybody got their notices. They want to make sure that everybody signed off on the accountings or a statement in lieu of an accounting. They want to make sure everybody provides their receipts. It's very hands-on. The default is they want to be involved to verify that things are going along correctly. One thing I should mention is that, most people, once they realize that probate's a 6-month process, they'll say, that's a headache. I don't want to deal with it. Let's just do a trust and move on. In Oregon, I have a number of probates that are in Washington County, and the court system there is so backed up. I submitted a letter yesterday to the court, and I said, this proposed judgment has been sitting in front of the judge for more than 12 weeks. My understanding is that at 12 weeks, we're free to submit a letter asking you to expedite this. And the letter that I got back from the court this morning is, we're busy. If there's an emergency, let us know, but we'll get to it when we get to it. So even though, if you're doing a probate, you are dependent on the court system working quickly and promptly, even when I quoted at 6 months. If, it takes 12 weeks or more every time I submit a proposed judgment, and I have no control over making that move forward faster, that drags, it can be 6 months for it to close out, just the closing portion, not the getting everything set up to close, but just the closing portion.
Boy.
Because you get 6 months for the judge to authorize, or if it takes 3 months for the judge to authorize the distributions, followed by 3 months for the court to close the case after the distributions have been authorized, that's 6 months.
Well, so what you're saying is be ready to wait then if something.
If you're taking it through the probate. And some people say, well, my family's getting a lot of money. What is it for them to wait some time to get it? And that's fine. But we just want to make sure they have all the information.
Got it. Okay. Now you mentioned having a revocable trust, and give us kind of like a couple reasons as to why you might want to do that. And obviously you mentioned avoiding probate. That could be a reason, but what other ones? I know one of them might be, using it in doubling up on the exemption at the state level. Yeah.
So tax planning is kind of the big second reason to do it. First reason is probate avoidance. Second reason is tax planning. Say you and your spouse own your house, some investment property, a brokerage account jointly. You can set up a trust, and you basically say it's a joint trust. When one spouse passes away, everything goes to the surviving spouse unless the surviving spouse disclaims assets. When those assets are disclaimed, they move into basically a credit shelter trust, so that when the surviving spouse passes away, those assets are excluded from their taxable estate. So that lets us utilize tax credits and exemptions that we couldn't otherwise use.
Got it.
If everything just goes to the surviving spouse outright, you don't use any of the exemption amount when the first spouse passes away, at the state level only. Everything is different at the federal level. At the federal level, the good news is that most people are not going to be subject to the federal tax. The bad news is if they are subject to it, it's a 40% tax. So it's anything over that threshold amount. And right now we're looking at basically close to 26 million as a couple, assuming everything is done right. We can utilize both spouses' credits. We're at 26 million. So, not very many people are going to be subject to it. That's under today's laws. If nothing is done, and generally if we're going to plan, we say, well, what's a path of least resistance? Nothing will be done. We're going to assume that it's going to sunset back to what the law was like previously. So as of 2026, it's set up so that each spouse will have about a $6 million exemption amount. The reason why I say it's an exemption, about a $6 million exemption amount, is subject to inflation adjustments. So right now, each spouse could pass 6 million together. If everything is done right, they can pass 12 million. Anything over that amount is subject to 40% tax.
Ouch.
Yeah. So, and bear in mind, I believe the federal estate tax has been as high as 70%. So even though it's 40% right now, that's always subject to, whoever's in office and what they want to do. Do they want to move it up? Do they feel like they need more money? I've been told that this is because the amount of people who are ultra wealthy, the amount of those individuals who make a lot of charitable donations, the federal government doesn't end up making a lot of money on the estate tax. So it's not a huge revenue generator for them. So if it's not a huge revenue generator, why make it a huge issue? But it smacks, the perception among a lot of conservatives is that it's essentially a death tax. They've paid all these taxes during their lifetime. Why do they have to pay more taxes at death? They're already getting hit at high income tax brackets. You understand that line of thinking. The other line of thinking is it's set up to be an estate tax. And so when they call it an estate tax, people feel like it's only impacting, the ultra wealthy, which right now, it's impacting people at a fairly high rate, a high number of assets. And, I think right now it's a hard sell in terms of, if somebody has 30 million or 26 million, it's only impacting them. There's just not going to be a lot of people that feel sorry for them being subject to an additional tax.
That's a good point. That's a good point. And speaking of like determining how much tax is due and figuring out what that taxable amount is, we've talked about that exemption. I do want to make sure that we clarify like what that is exactly. And so when we're computing like the taxable amount for an estate, you basically add up the value of what you got. And then what are the subtractions from there? Any debt that the decedent had, fair market value of any mortgage, any debts, any assets going to charity. That's what estate administration costs. Okay, so it's the asset value minus liabilities, debts, loans that are outstanding, minus the charity that, what's planned to be given to charity, and then finally subtracting out that exemption amount. Mm-hmm. So like for Oregon, you mentioned it's $1 million, and then for Washington, it's a little over 2. Yeah, 2.2. 2.2. And then federally, we're up there quite a bit more than that. It's shy of 13 million per person. 13 million. Okay. So if you take your value of your assets minus those different line items, if you still have a positive number, then we're looking at a potential tax. Mm-hmm. And so what for Oregon and Washington, I know it's similar to it has marginal brackets. So where do things basically start at the lower level? They start at 10 for Oregon. They start at 10%, and then once a person hits 9 million, the marginal bracket is at 16%. So 9 and then 16. Okay. Yeah. I mean, sorry about that. So so we're looking at 10% once they hit the $1 million mark, and then at 9 million, they're looking at about 16% tax. And I think Washington's tops out at a higher bracket than that. And Washington's got a higher bracket than that. Yeah. So it's worth knowing that number ahead of time, right? Because once you're passed on and now these assets are going to kids or whoever you want to leave it behind to, they're going to be stuck with this bill before they get their assets, correct? I mean, that needs to be paid out. The government they got their hand out first.
Right. And it's paid by virtue of somebody dying. It's not paid by virtue of somebody inheriting. So that's why I like to call it a death tax, because it's imposed once on somebody's death. Right. And it gets confusing because really we have a death tax in Oregon. There are some states that have an inheritance tax that are imposed by virtue of a person inheriting assets. And so the act of receiving the assets is what triggers the tax. I think there's 5 or 6 states that impose it upon inheritance.
Interesting. Okay. Yeah, no, that's good. And so we really need to be aware ahead of time. And that's where doing some planning, folks, can really come into play. Mm-hmm. With what we have here at Harlow Wealth, we're able to really give you that number, and seeing what you're up against as far as that potential estate tax bill that you're going to leave to your heirs before they can even get a dime. The government's got their hand out and they're going to take a piece of that pie. So how do we reduce that? How do we make that piece that they're going to be taking the smallest piece possible? And because in many circumstances, like, they're going to get theirs, they're going to get it in some way or form. But how do we pass on what we have to our family in the most tax advantageous and efficient way? So that's where looking at potentially like a credit shelter trust, as you were mentioning before, where we can basically double that exemption amount that we have at the state level. That's the easiest way, isn't it?
$100,000 savings. And I have to say that can be $100,000 savings, because we also have, say it is $100,000 savings for the Oregon estate transfer tax. We also have to take into account how it impacts capital gains. Because say you have one spouse who passes away and there's a couple that's 40 years old, and those assets that they have are going to be exposed to a lot of asset appreciation. It might make sense just to leave those assets in the surviving spouse's name, not do a credit shelter trust, because we want more favorable capital gains treatments to be applied to all their assets once that surviving spouse passes away.
Got it. So you're saying that if we did a credit shelter trust, by moving those assets that could eventually get a step up in basis by using the trust, the trust doesn't get it.
Yeah, if it's excluded for purposes of the surviving spouse's death taxes, then you don't get that second date of death. You don't get a basis step up on those assets once that spouse passes away. So, it just depends if that surviving spouse lives a long time and those assets really appreciate, or if the stock market is going crazy, sometimes it's better to get that basis step up. I know of really good tax attorneys in Oregon that just say, given the need to get a second basis step up on all the assets, why do a credit shelter trust? But I think, if you're going to do it right, you have to look at each client's individual situation. And if you have, if you're looking at an elderly couple that's been together for 50 or 60 years and the surviving spouse isn't going to live that long after one spouse passes away, I think you really do want to utilize that $1 million exemption amount.
Gotcha.
$100,000 savings. There's not going to be that much asset appreciation.
Understood. Yeah, that's actually a great point. And another reason why, taking a cookie cutter approach just isn't the right way to go, because it really depends on everyone's situation and which is unique. And so,
yeah. I have one client who his wife passed away, and he hates anything. He hates paperwork. He hates anything complicated. He's really smart, but he just doesn't want to have anything to do with it. He had a lot of cash, and he said, I don't want to deal with a credit shelter trust. And I said, well, you could just gift it. There's no gift tax in Oregon, and at the federal level right now, you can gift $13 million per person. You can just gift cash. There's no capital gains issues. And he said, I'd rather just gift cash to my daughter and move on. And there's other people that have enough assets that when one spouse passes away, it makes sense just to give $1 million to the kids and use up that exemption amount versus put it into essentially a credit shelter trust.
Gotcha.
And I like that approach, but the issue you run into is there's a number of people that, even if they have, substantial wealth, they say, how do I know I'm not going to run out of assets? I don't
Right.
want to go back to my kids and ask them to give me money.
They're like, wait a minute, I gave you a little too much. Can I have some
Yeah,
back?
yeah. And so I'm like, well, there's got to be a bias towards keeping life as simple as possible for people. And we can't let the tax consequences drive everything. So it's like putting the cart in front of the horse.
Yeah.
We want people to be aware of what's going on, but we want, we want to keep it as simple as possible. There's too many mistakes made once you go to a very complicated level.
Yeah, and we want to do our best to avoid that. That's for sure.
Yeah.
You mentioned step up in basis, and just to make sure everyone is on the same page about what that is and what type of assets that applies to, could you give us a little rundown of that?
Well, there's even a difference in between Oregon and Washington. In Oregon, if you have a jointly held asset and one spouse passes away, there's a basis step up by about 50%. Because we're just doing a basis step up on the deceased spouse's portion. In Washington, which is community property, we get a basis step up on all community property. So even the surviving spouse's part also gets a basis step up.
Interesting.
And in California is the same way. It's community property. So it's to the extent somebody moves to Oregon and they say, oh, we spent our entire career in California, we're now moving to Oregon. We want to earmark basically all their assets as community property so that when one spouse passes away, we have the argument that we can step everything up. 100%. Because we want to have the argument that it was all community property. It was their agreement to keep it as community property. It's not been commingled. Just step it all up.
And stepping up that basis basically means, like, could you give us an example of something that
that means when both spouses are when the person inherits the assets, when they sell it, they want to be able to not pay any capital gains. So because the IRS will treat it as if the property was purchased on the date of death and will assign a cost basis equal to fair market value as of the date of death, the kids can turn around and sell that property without incurring any capital gains.
Okay. So if you think of like a mom and dad's house, for example, and they bought it, way back when for $50,000, and now it's worth $1 million, let's say. So in that situation, if they both pass on, then the basis of that house steps up to be equal to what the value of it is today. So you're saying the basis would equal $1 million. It's worth $1 million. They could turn around and sell it right then and there. So because their basis is equal to the sales price, there's no gains there, correct? Perfect. So I do get from time to time, well, we didn't sell mom and dad's house right away. We kept it, we rented it out, or we just kept it as an investment or held on to it for whatever reason is. But we want to sell it now, let's say a couple years after they passed on, and they're wanting to utilize their 121 exclusion. So the $500,000 that they could otherwise use if they were alive, if they sold their house by themselves, the tax code allows us to sell our primary residence and exclude gain. Now, is that an option at all for people who inherit a primary residence?
So are you asking whether they can get the date of death basis step up and a 121?
Yep.
I wouldn't know. I would have to look into that. I would doubt that. Because what you're looking at is a situation where houses, continues to appreciate like it has over the last 3 or 4 years, where, it's 10 or 15% per year. And then you get a date of death basis step up and it's $1 million house. And then there's a couple extra 100,000 of appreciation. You're wanting to exclude that.
Right.
I would have to look it up because I just don't know.
Okay. Yeah, that's a complex one, but that's the thing with taxes.
I would doubt that they could get a doubles. I would doubt that they could get both of them, but that's different than actually reviewing it.
No, it's a good. All of these are good questions. Taxes are just complex, and it requires us to look them up from time to time. So no harm there. We did have a question come in. If a couple has a will and one of them dies, do all the joint assets they have with their spouse go into probate? In other words, does the surviving spouse have to wait 6 months to use the money in their joint account or sell the house?
I've never seen that be an issue where they need to wait 6 months. With a home, there's an automatic right of survivorship, at least in Oregon, if a husband and wife own property together. So say husband passes away, wife survives him, wife would need to take a copy of the death certificate and record that with the county. That's enough for title to be vested in her name, and then she can sell the property. Or she could just skip that step altogether and let the title company handle it. They're going to come back and ask for a death certificate and record it. But that's fine. The one thing that gives me pause about joint assets in the question is that it needs to be clear on the beneficiary designation, on the banks or the financial institutions policies, if joint accounts automatically go to a surviving spouse, or whether or not they need to check a box that says with rights of survivorship. A joint account in Oregon, if you look at joint property, at least with deeds, if the deed itself, and if it's not a married couple, if the deed itself would need to call out with rights of survivorship, otherwise it'd be presumed that there's no rights of survivorship. Just because something is jointly owned doesn't mean that it automatically goes to the survivor. You have to look more into the actual paperwork on file with the financial institution.
Interesting. Good question, Colleen. Thank you for submitting that. We did have another question in from Steve Farrar. I'm not married and leaving everything to my 2 daughters. I own 6 rental houses in Washington. How can I keep them from being counted in my estate for Washington death estate taxes? Do I need to move from Washington to a state with no estate tax, like Florida?
So the first way of helping with tax avoidance is to move to a state that is more friendly than Oregon, especially Oregon is. Washington is somewhat more friendly than Oregon is, but Washington still has that death tax. So you talk about moving, that doesn't entirely solve it, because by virtue of the fact that it's real estate that's physically located in Washington is enough for the state of Washington to claw into their taxable estate and the jurisdiction for being subject to death taxes. One thing that people have done in Oregon, and I don't know, I would assume that you could do the same thing in Washington, but I need to double check, is that they will say, these real properties, this property is really my business. I'm going to put it in an LLC. Once it's owned by an LLC, then the government tends to look at it and say it's an intangible, just like any other stock is, and it's located wherever the person lives. So theoretically, and I'm not saying this is certain, I'd have to double check it, but theoretically, you could transfer the real estate into an LLC. At that point, you no longer own real estate. You move and put your physical residency being in Florida. I don't know anything about Florida's tax situation, but that might clear it, so you wouldn't be subject to death taxes.
Steve, it sounds like you need to sit down with Ginger. That's a good one. So basically, you're saying they own LLC interest, not real estate.
So it creates it as an intangible property interest, just like owning a stock certificate. Yep. Stock certificates are located and subject to the jurisdiction of wherever that person lives at the time of their death, their residency.
Got it. Okay.
So it's a way of getting around it. But, yep. I know Oregon's that way. I don't know for a fact Washington is that way, and they could be that way, and then they could pass a law and things could change.
So assuming that's not the case and he does nothing, the fact that he has real estate in Washington, so that those assets and those assets alone would be subject to Washington estate tax, not all his other assets.
I was just looking at this for Oregon purposes yesterday because I have somebody that lives in Australia, and they own one piece of property here in Oregon, and we're putting it into a trust so that they can do probate avoidance. And I was looking at it, and they were basically saying, you still basically, you just say that only the assets that are the real estate or whatever are located in this state. It just triggers the fact that a real person owns real estate in the state, or likely in Washington, triggers the need to file a death tax return. Moving to Thailand, I connect with that in the sense that I'd rather be in Thailand than in Portland. But as long as you retain your citizenship, you're considered U.S. person, you're taxable on your worldwide income. You might be able to say that you're no longer subject to Oregon's income taxes and Oregon's death taxes or Washington's taxes, as long as you don't own real estate. But yeah, sell the real estate, don't have anything located in Washington, and move.
Yeah. Well, we have another one that just came in from Debbie Swank. We are both retired and live in Arizona. We have a living trust. We have a lot in Washington that we want to sell or gift to our son. The lot adjoins his property. Can we quit claim deed it to him without a tax consequence?
There's always going to be a tax consequence. It's going to be treated as either a sale or a gift. You have to decide, you have to sit down with your son and decide what you'd prefer. If you gift it to him, he takes whatever basis you have in the property. So, if you were to hold, I don't know your ages, I don't know your health. If you were in poor health and you're not expected to live a long time, then it might make sense to just hold on to it so you can get the date of death basis step up, and he can have more favorable tax capital gains treatment. If you're in great health, you're gonna just have to have a conversation with him and ask him if he wants to buy it. But he's always going to prefer just to be gifted the property versus buying it. That's a no-brainer. But not only so, when you go to record the deed, you also have to file a excise tax in Washington, because the transfer of real estate triggers the need to file I think it's a real estate affidavit, which is an excise tax. I would have to look up the value. The reason why I'm hesitating is yesterday I was working on this and I had Washington County and Washington State excise taxes at issue. And I know one of them was $1 per $1,000 of transfer. So if it's $1,000 worth of real estate, you pay $1 in taxes. But there is an excise tax that you have to deal with. So the default in Washington is that any real estate transfer is subject to the excise tax. But it's up to you to come up with an exemption that they will accept. So if you can say that it's a transfer because it's a gift, or a transfer because of an inheritance, or, in Washington County, at least you can say that it's a transfer for less than about $14,000 and you're clear. It's a mere change of identity as Washington County. So yeah, it gets to be a headache trying to keep it straight in between Washington State and Washington County. And in terms of the excise taxes that are charged whenever you record a deed. Yeah,
that's a good question. And as far as like the tax consequences on if you do gift it, just quit claim deed it, besides the excise tax that Washington charges, as far as income tax go, there really isn't one. There's no gift tax. There's no estate tax. It might trigger the filing of a gift tax return.
Mm-hmm. It would trigger the filing of a federal gift tax return, and I'd have to look at Washington law again to see what it does on a state level. But so the penalties for not filing a gift tax return at the federal level are based upon the taxes due. And if there's enough exemption, the penalty will be zero. So it doesn't matter if the penalty is 20% of the underlying taxes that are due. If no taxes are due, there's no penalty. And at the federal level right now, you can gift about $13 million before there's any taxes due.
And by having to file that gift tax return, let's say that lot was worth, $250,000, then all that basically does is it just eats into that lifetime exemption amount, correct?
Yes.
So it's just kind of an accounting that the IRS is keeping by you filing that gift tax return, even though no dollars will be due from you or your son in that filing, unless you happen to have eaten up your entire lifetime exemption amount of $13 million, which is unlikely. So
the other thing it does is it provides paperwork for showing what the basis is, so that when the son goes to sell the property in the future, he can have some sort of paperwork showing where his starting point was for basis purposes.
Right, because the son would be basically taking on and stepping into the shoes of the parents as far as what their basis was. Yeah, so a lot to think about. This is why we got financial advisors and attorneys helping us out. But great questions. Keep them coming, folks. All right, we're gonna move on. We don't have a whole lot of time left, Ginger, but I did want to get to a couple more items. So you mentioned that the federal exemption amount, this is more for our high net worth clients, the federal exemption amount is being lowered from what it currently is to a lower amount, I believe $5.6 or around that level, $1 million is the exemption come 2026. For those high net worth individuals that have a really high estate or plan on having one or will be coming into some money and just have a very high net worth, is there anything they should be doing now in between 2026 when that exemption amount lowers?
There's a number of things that can be done. The question is whether or not people want to do those things and take on the level of complexity that their life might have. I have one client that I think he and his wife together probably were worth around $40 million, and he decided to use up his entire unified credit of about $13 million because he wants to make sure that if he were to die in 2026, that he's already passed basically $13 million on. Like if you use up that exemption and then they pull it back down to $5 or $6 million, you've used it. The IRS is going to let you keep it. So I have one client that's doing that, but he's 80 plus, and he's done it through gifting, and it's relatively complicated what he's done, but it also makes sense. It could have been a lot more complicated. He's trying to do like a something that's going to benefit multiple generations for a long time.
Okay, gotcha. Yeah, so there could be some areas to look at, but weigh out the complexity that might come with it.
Yeah,
that's good. Speaking of gifting, talk to us about like how much one can gift each year without having to trigger a gift tax return, and it's just kind of like the free and clear amount that we can give and start to chip away at that estate value that we might have. And
so you can gift 17 million a person, or not 17 million, 17,000 a person. Your spouse could also gift 17,000. So what you'll see with people that want to be aggressive about dropping down the value of their estate is that it's basically, I guess it's 34,000 per individual if you've got 17 coming from mom and 17 coming from dad. And then you do that for all the kids and you do that for all the grandchildren, and then you do it in cash. So that would be after a commercial building is sold or after a house is sold, when there's a lot of cash floating around. Those are good gifts. With cash, it's such an easy gift, and that there's no questions about value. So the IRS can't come back in the future and audit valuations used. There's no capital gains issues. The person receiving it has a lot of flexibility on what to do with it.
Yep, that's good.
But I want to be careful, because I think that people should not feel hemmed in by only giving 17,000 a year. If you go above that mark, you just need to file, or you need to tell your CPA to file a gift tax return. And the biggest issue is really capital gains.
And I also get this question quite a bit. Is there going to be any tax consequence to the person I'm giving money to, especially if I go over that exemption amount? And the answer to that is no. That whoever is receiving that gift, they're not going to have any like income tax consequence.
The trigger is done because the person made the gift, not because the person received the gift.
Got it. Perfect. And we had a question come in. Do you need to keep track of money given to each person?
Well, that gets into family dynamics too. So for you, it's going to depend on whether or not you feel the need to prove out to your other kids that you have been equal and fair with everybody. It's your money. You can do with it as you want, especially during your lifetime and when you have good capacity. You can do with it as you please. But anybody that knows about human nature would also say, and there's consequences.
Right.
In terms of how the other kids are going to receive it. I always wonder, because sometimes I get clients that come in and say, I'm going to disinherit this girl because she's gotten plenty of gifts from me during my lifetime. And the person, if the person that's making that statement has a sizable net worth, and that child would have otherwise received $1 million, I say, did they really receive $1 million in miscellaneous gifts here and there? Or is this parent just annoyed that this child's never got their feet under him and doesn't want to give him any more?
Right.
Maybe they've given them $200,000 or $300,000, but they feel like every time they turn around, that child needs money, and they're just sick of giving them money.
Yeah.
So to answer your question, it depends on just what you feel comfortable with, what's okay within your family dynamics.
Got it. All right. So talking about beneficiary designations, you mentioned that a little bit ago. And, what is the real rule on beneficiary designations compared to what has been listed in a will or a trust? Which one outweighs the other?
The beneficiary designations take precedence over anything in a will or a trust. And the lesson learned by me was when I was relatively new into having my own practice. Somebody came to me after he bought $1 million life insurance policy. He told me to remember one of his kids' social security numbers. And so he said all $1 million goes to this one child. And he came in and did his will. And he thought that in the will, he says everything equally to all 3 kids. And so somehow it came up that he had not put all 3 kids down on that beneficiary designations for life insurance policy. And he believed that the will took precedence. So we were able to straighten it out before it caused any problems. But to me, I will always remember that because the potential for there being a problem was really high.
Yeah.
In a situation where, it was well intended. Right.
Okay. That's good to know. Good to know. So we want to make sure our beneficiary designations are up to date. That's what rules. All right. So I did have another client bring in this question. If a client dies with an outdated will, in what order does the spouse sit in probate in Oregon? For example,
I wanted to highlight one thing and then move on. The court is not going to say this is an outdated will. The court is going to look at it and say, is there a will or not? And if there is a will, then and it's valid and it's not been revoked, then we're going with it. But they're never going to term it as an outdated will. So I think the question really is, if a client dies and there's no will at all, where does the spouse sit?
Mm-hmm.
It depends, which I know is not very helpful.
Another attorney statement.
Another attorney answer. It depends. If this is a happily ever after marriage where all of your children are together, the spouse, it takes 100%. If this is a blended family where the spouse where both spouses have children from prior relationships, then the children take 50% and the spouse takes 50%. Mm-hmm. And that's assuming that we're really looking at probate assets. Again, if you bought the house and you said husband and wife own this property, the presumption is 100% goes to the surviving spouse. If you set up your retirement accounts and said we want 100% going to the surviving spouse, then that's what happens. If you set up brokerage accounts and your name's on title jointly and everything, all the boxes are checked that make everything go to the surviving spouse, the will and intestacy provisions don't even come into play.
Got it.
It can be a harsh result, Yeah. Dad puts all of his money into a house and then they do a lot of renovations and, wife number 2 is on title and she receives everything and his children don't receive anything.
Mm-hmm. Yeah.
So it's something, we have to deal with problems that we actually have. So if you have a blended family, it's just something to be cognizant of.
Right. Okay. Well, kind of summing up here, when it comes to a will and a trust, those seem to be some items that are pretty common. And give us I'm guessing the answer is it depends, but give us an example of just price wise, if someone wanted to work with you and your firm, where something like that might fall as far as creating it for someone.
So in terms of the cost for estate plans, we do them on a flat fee. The range is it ranges from about $1,500 all the way to about $4,200. And that's just assuming, this is not getting into the fancy, ILETs or life insurance trusts or, some of the stuff that's done for ultra high net worth people. It's kind of what's standard. So when you say $1,500 for a will, that would be for one individual. So if they're married times 2, and then $4,200, that's the top for a married couple. You wouldn't say 42 times 2, you just say 42. That.
Got it. Okay. And if someone wanted to just have a consultation with you, what does something like that look like?
We generally bill those by the hour. We used to do free consultations, but we had 50 requests in 1 month. And now I don't answer the phone unless I know who it is. And so then it's just billed at my hourly rate. My hourly rate is $420. And then I have another attorney that works for me and his is $300. It's on the low side, but what do you do? I also like having his rate lower. So
Right. Okay, very good. Well, awesome. Any last thoughts about just estate planning and what maybe people should think about that are retiring?
There's just a lot. I mean, estate planning seems deceptively simple, and for some people it is really simple. There's a lot to keep in account. A lot of questions that we didn't go over today, like the impact of divorce on an existing estate plan, the impact of marriage on an existing estate plan. What do you do if a couple lived happily ever after for a long time and the one spouse died, another spouse remarried? What do we do to protect the assets to keep everything from ending up in the hands of stepchildren? What do we do to minimize the potential for undue influence claims? What's the impact of a non-citizen spouse? There's just a lot more that would really need to be tailored for each individual situation.
Yep, absolutely. Well, you're right. I mean, when it comes to estate planning or financial planning in general, there's just there's so many questions, and we want to make sure that we get it right. And so I want to encourage everybody to make sure that you're checking off all these boxes, and we boil it down to its simplest form, simplest thing that we could build out, and that's the Harlow way. So it's built on the 5 key elements that we address in each of our financial plans: income, an investment strategy, a tax strategy, healthcare strategy, and then finally the estate plan and strategy there. And so, today we're addressing that fifth pillar, that 5th step. But folks, we got to make sure that we check it off. And so, whether it's out of date or you want to get things going or things have changed in your life and you want to make sure that you're on the right course, we can give you that leadership. And along with Ginger and her office, we'd be happy to sit down with you, make sure that we got all our ducks in a row and that we can keep the hands of the government out from, the assets that you've worked a lifetime to build up. So I hope you enjoyed today's version of Wisdom Wednesday. Ginger, I want to thank you again for taking the time out of your busy day to come join us. And if people want to get a hold of you, what is the best way for them to do that?
I would just encourage people to go to my website. It's www.skinnerlawpdx.com. PDX is the abbreviation for the Portland Airport. Again, I try to keep it simple. When I did my estate plan, I kind of hear my dad's words in my head because he was always like, these businesses make it so hard where you have to dig to find the phone number. You have to dig to find contact information. You have to dig to get a hold of them. Why can't they put it out there? So I put my phone number in big letters to make it as easy as possible. But I'll give you my phone number anyway. It's 503-719-6603.
6603. Okay, perfect. I'm going to set that on the sticky message so anybody can who's watching can see that. And we want to thank you, our audience and clients and prospects, for joining us today as well and taking time out of the beautiful day that we got here in Portland, Vancouver area. This is why we live here, right? Is for the days like today. And so thank you for taking the time. We will see you next time on Wisdom Wednesday. Bye, everybody.